With Iran threatening to cut off 20% of the world's oil supply, you'd expect total market panic. But as CryptosRus highlights, while oil prices surged 8%, Bitcoin is holding steady around $66,000, acting like a true safe haven asset amid the chaos. However, this geopolitical strength could be masking a much deeper economic threat. According to Crypto Banter's analysis, the U.S. economy is flashing major warning signs not seen since 2008. Auto loan delinquencies are now higher than during the financial crisis, and corporate insiders are selling 5 times more stock than they are buying. So, who is buying? The modern investor points out that while retail is fearful, big institutions are steadily scooping up Bitcoin, with spot ETFs absorbing hundreds of millions. We have a geopolitical shield, an economic storm, and smart money making quiet moves. Which force will ultimately win? In the latest video from the CryptosRus channel, the discussion centers on major geopolitical events and their surprising effect on the crypto market. The big news is the removal of Iran's supreme leader in a military strike, which has created a ton of uncertainty. Iran is now threatening to cut off the Strait of Hormuz, a critical channel for 20% of the world's oil supply. This threat alone caused oil prices to jump 8% to $72 a barrel, and the futures markets for the U.S. look absolutely horrible. What's really interesting, though, is how Bitcoin is reacting. Instead of tanking with the grim global outlook, Bitcoin is holding strong, around $66,600. The speaker finds this very encouraging and suggests it might be because people in the affected regions are flocking to Bitcoin as a safe haven to move their wealth. He also briefly touches on how the U.S. having access to Venezuela's oil could change things, and the curious silence from China and Russia on the matter. It's a messy situation, but crypto stability is the unexpected silver lining. The video's focus on Bitcoin's resilience amid geopolitical turmoil touches on the long-debated safe haven narrative. Recent events seem to support this view, at least in the short term. While the speaker highlights the threat to the Strait of Hormuz, S&P Global reports that shipping traffic has already dropped significantly after the strikes, with some outlets calling it a de facto closure. This has caused real supply disruption, pushing Brent crude prices up. Interestingly, OPEC Plus responded with a surprisingly modest production increase of 206,000 barrels per day, suggesting a cautious approach to managing their spare capacity. In this volatile environment, Bitcoin has indeed held its ground, oscillating in the mid-$60,000 range even as traditional markets brace for impact. This performance lends credibility to the idea that in times of state-level uncertainty, a decentralized, non-sovereign asset can become attractive. However, the safe haven thesis is complex. Some analyses show Bitcoin's correlation to geopolitical risk is inconsistent. The current stability could be a temporary reaction, but it undeniably strengthens the argument for Bitcoin's role as a store of value outside traditional systems, especially for those in politically unstable regions. In the latest video from Crypto Banter channel, guest Steven Van Metre lays out a compelling case for some serious cracks forming underneath the U.S. economy. He points to the private credit market, which is seeing its worst downturn since 2008, with firms like Blue Owl having to gate redemptions because too many investors want their money back. This isn't just some isolated issue. It's tied to businesses that borrowed heavily, and now the inventory isn't selling. Why? Because the average person is getting squeezed. Auto loan delinquencies are already higher than they were during the 2008 crisis. Credit card debt is piling up, and personal savings have hit a 3-year low. The whole show is basically being propped up by the wealthiest 10% of Americans, whose spending is tied to a stock market that looks increasingly shaky. Van Metre notes a huge disconnect between stock prices and the weakening labor market. A big reason for the market's strength, corporate share buybacks, is likely to shrink as companies divert cash to AI-related capital spending. Tellingly, corporate insiders are selling 5 times more shares than they're buying. This whole situation creates a fragile system where if the stock market rolls over, the spending from the wealthy dries up, and there's no one left to hold things up. It's a sobering look at how a credit crisis could unfold, something Bitcoin has never really had to face. Steven Van Metre's analysis highlights critical stress points in the economy that are becoming more pronounced. Recent data from early March 2026 shows a significant 30.9% year-over-year jump in early-stage mortgage delinquencies, suggesting the consumer strain he described is expanding. While some outlooks for the private credit market remain optimistic about growth, they also acknowledge rising risks from interconnectivity with traditional finance and weaker covenant protections. Van Metra's warning about corporate buybacks seems timely. Bank of America recently reported that buybacks by their corporate clients have slowed and are tracking below seasonal trends. This reduction in the market's biggest buyer could remove a major support for stock prices, just as he predicted. The scenario of a credit-driven crisis presents a complex picture for crypto. Initially, a scramble for liquidity would likely see assets like Bitcoin sell off heavily alongside equities, as seen in past shocks like March 2020. However, some analysts like Arthur Hayes argue that such a crisis would ultimately force central banks to inject massive liquidity, which could propel assets like Bitcoin to new highs as a hedge against fiat debasement. This positions Bitcoin in a dual role, vulnerable to the initial liquidity shock but potentially a prime beneficiary of the inevitable policy response. In the latest video from The Modern Investor, the conversation kicks off with a look at the crypto market's mood. It seems the general fear from recent tariff and conflict news is starting to fade, leading to some price rebounds. There's a feeling that Bitcoin might have found its temporary floor around the $60,000 mark. A big part of the story is the steady hand of institutional investors who are continuing to buy, scooping up assets while many retail investors are sitting on the sidelines. In fact, spot Bitcoin products saw $254 million in net inflows on February 26th, showing that the big players aren't slowing down. The video also dives into Ethereum's ambitious new straw map for the future. The plan is to seriously upgrade the network by 2029, aiming to slash transaction finality times from 16 minutes down to just seconds. However, the host points out that we've heard big promises from Ethereum before, and with Wall Street now at the table, the pressure is on to deliver. Finally, there's a look at how Bitcoin is being integrated into more traditional financial products, like a new $188 million bond backed by Bitcoin-secured loans. While this shows Bitcoin's growing acceptance, a word of caution is offered about the risks of using your crypto as collateral for loans. The video's focus on institutional buying and Ethereum's development roadmap touches on two of the market's most critical, ongoing narratives. While the transcript mentions strong ETF inflows in late February, the picture in early March 2026 is more mixed. Recent reports from outlets like Morningstar and KuCoin indicate periods of significant outflows from spot Bitcoin ETFs, suggesting institutional sentiment can be fickle and reactive to broader market de-risking. However, analysts from Bitwise and Grayscale maintain a bullish long-term outlook, believing these dips are seen as buying opportunities by slower-moving institutions. The discussion around Ethereum's 2029 straw map is particularly timely. While the video rightly expresses some skepticism based on past timelines, the Ethereum Foundation's recently detailed 2026 roadmap, focusing on upgrades like Glamsterdam and Higata, shows a more structured, engineering-focused approach. These upgrades prioritize scaling through Layer 2 solutions, which is where the real transaction speed improvements are happening right now, making the 2029 goals part of a larger, more modular strategy rather than a single monolithic promise. This push is essential as competitors continue to challenge its dominance. Finally, the emergence of complex financial products like Bitcoin-backed bonds is a clear sign of market maturation, though it also introduces new systemic risks, a sentiment echoed by JP Morgan's analysis on the complexities of integrating such a volatile asset into traditional portfolios.
After analyzing these different perspectives, it's clear the crypto market is being tested by powerful external forces. All our sources see a fragile global environment, whether from a looming credit crisis, geopolitical conflict, or general uncertainty. But they diverge on what matters most. Is Bitcoin's future driven by a flight to safety from war, steady institutional buying, or the threat of a massive economic sell-off? The biggest unanswered question is which of these powerful forces will win out. The key takeaway: crypto is no longer isolated, Its resilience is being tested against real-world crises, and how it responds will define its role for years to come.